Banks forced to dip into their own capital. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. I have my stein of coffee, and I thought we'd have a look at this article from Mortgage Business, because it's, well, particularly interesting regarding the proposed changes to the Banking Act of '59 to stop our deposits getting bailed in. So let's have a look at this. Banks are urged to dip into capital buffers to fuel lending. It's all about lending. The cash rate is embarrassingly low, 0.25. The Reserve Bank is trying to push us all to borrow. Apparently we're lazy entrepreneurs here in Australia because we're not employing enough people and we're not borrowing enough money. I mean, you'd have to be in a pretty good position right now to take on additional borrowing to invest in your business. I was talking to a mate. He spent 40 grand on a new expensive piece of equipment. He didn't borrow the money. He paid for it in cash. So there you go. People are, and he said, oh, maybe I should have borrowed it to claim the interest. And mate, it doesn't make sense. It's crazy. It's cheaper in the long run. So that's the thing. People being smarter, everyone. Lenders have been urged to leverage their strong capital positions to facilitate the continued flow of credit to households and businesses as part of a broader economic recovery effort. Just think about that. Just think about the picture that's painting. Just a greater flow of credit to households and businesses. Is it just going to be a debt-fueled recovery? Consumer purchasing? Or are people just going to wake up and go, no, not anymore. I'm not getting back to this position. We're only surviving. This is the story I have in my head, a couple. We're only surviving because we're on, JobKeeper, mortgage repayments. We've got 3 investment properties that we can't rent out. That story will be playing out. And they'll go never again. The Council of Financial Regulators, which includes the Reserve Bank of Australia, Treasury, the Australian Prudential Regulation Authority, and the Australian Securities and Investment Commission, and we're a free market, everyone. We're a free market with no intervention. What bullshit that is. Has published its latest quarterly statement, which focused on the ongoing response to the pandemic crisis. CFR was cautiously optimistic about the economic outlook and acknowledged that while the crisis induced the biggest economic contraction since the 30s, signs of a steady recovery have emerged. Really? We'll have to see, because that seems to fly in the face of IMF predictions about a decline in our GDP and a decline in GDP of all our major trading partners. But they're saying it. Is international tourism going to suddenly switch back on? Mate, you know what it is. They're just reading all the domain articles about people paying above reserve. That's what it is. That's the basis of it, of course. As a result, economic activity is now beginning to recover in some sectors. Really? Of course it will, because you've switched everything off. You've switched it back on. It's going to take years to get back to where we were. The Prime Minister's even said that. We haven't even seen all the mechanisms propping up the economy removed to see how it reacts. Conditions in financial markets internationally and in Australia have improved after a period of significant disruption in the early stages of the pandemic. Well, so this is from a few days ago now, and they've taken a hit again. CFR lauded the coordinated economic responses from governments, regulators, and the private sector, which it said is working with help to support the recovery ahead. However, the regulators stressed that the outlook remains uncertain, adding that the pandemic would likely have long-lasting effects both locally and globally. The financial sector has therefore been urged to continue to support the recovery effort to cushion the effects of shutdown measures on households and businesses, with the CFR noting the importance of a cautious transition from financial relief measures, including loan repayment deferral periods, set to expire in September. The thing I'm most worried about is the fact that directors aren't liable for trading while insolvent at the moment, where the rules have all been changed. Members agree that financial institutions, regulators, and governments will need to continue to show flexibility in order to support the objectives of economic recovery, resilience of financial institutions, and fair household and business outcomes, the CFR added. As part of the financial sector's contribution to the recovery, the regulators have called on lenders to dip into their capital services to help facilitate continued flow of credit to the economy. APRA has reiterated that the large capital buffers above regulatory minimums that were built up in more favourable times ought to be used during the extreme shock, the CFR stated. Members encourage institutions to make use of their capital buffers to continue to support businesses and households. In March, APRA made temporary changes to its expectations regarding banking capital ratios to ensure banks were well positioned to continue to provide credit to the economy. There you go, changing the rules. Remember when we had the Royal Commissions and there's all these tightening on lending requirements? Don't worry about that anymore. Don't worry about that. Just get in there. Buy those houses, guys. Plebs, what are you doing? Get that house. Buy that first house. Property never goes down. Never goes down. Haven't you seen these 15 articles where everything's above reserve? Then halfway down the bottom we'll mention a property that was passed in. Haven't you seen all those? FOMO. Media, more FOMO now. I'm getting too cynical about it all. APRA noted that with banks maintaining capital levels well above minimum regulatory requirements, it would be appropriate to enable them to use the large buffers they've established to facilitate ongoing lending to the economy. As a result, provided that banks meet their minimum capital requirements, it would not be concerned if they were not meeting the additional benchmarks announced in 2016 during the period of disruption caused by the pandemic. So they're throwing all the rules out. All the mechanisms they put in place to ensure safety, it's all been ignored. It's all being ignored. So make sure you get your submission in to the Senate inquiry regarding stopping bail-in of bank deposits. Banks have also received liquidity support from the RBA, which has purchased approximately $54 billion in government bonds from banks, ramped up repurchase transactions, repo, via the overnight market operations, and made $90 billion in low-cost business funding available via its term funding facility. As of the 17th of June, only $11.5 billion had been drawn down from the TFF by Australian banks. So there you go. They've got $90 billion they can get, and only $11 billion has been loaned. What does that tell you about consumer confidence? What does that tell you about business confidence? So people aren't jumping on board to borrow money to put in these things. People are worried. People are having to let staff go. The scary thing is, what if people are borrowing money to keep their teams on? This leaves approximately $72.5 billion in funds available for the bank to draw down over the coming months, with the TFF expiring on the 30th of September. So there you go. So Kabul, an interesting look at, the bank's urge to use their capital to fuel more lending. What does that tell you, everyone? What does that just say? Particularly from the other pieces we've looked at, the Reserve Bank governor's concerns with our economy. I'm not surprised that businesses haven't taken advantage of the full $90 billion in low-cost loans. You'd have to be pretty ballsy to be taking on debt now for business, with just the way the economy is going, with the fact that we've got a recession looming. No one in tourism will be doing it. Would people in construction be? Maybe, if they've got enough work lined up, if they've got government work. Maybe people investing in health facilities or something attached to the medical sector might be. But it just shows you that's a sign, isn't it? We'll have to see. And normally people would have jumped at it before the end of Fin. So maybe this will jump up before the end of June and we'll see a big hit to it. What do you think? Well, guys, thank you all for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us via our affiliate links at Amazon or eBay or Independent Reserve and Kucoin. You can buy our merch from HeiseSays. You can support us via PayPal or using Gold Pass from the Perth Mint. Thanks, everyone. Have a great day. I'll see you next time.